All right, now, last time we had Ed Keon of Quantitative Management Associates on the show in May. He was a nervous bull, and even though he admits the economic data have been weaker than he thought, he's still not bearish. He joins us from Newark, New Jersey with more. Ed, thanks for coming back on the show. Let me ask you what you thought, what's the most disappointing to you in the economic data that we've seen since last time you were on?
Well, I think the jobs data, the jobs report we got from last month was pretty terrible. I had thought we were starting to see some traction, and I think we did in the first 4 months of the year, especially in the household survey, showed 1 million jobs being created. But basically, it looks like the job creation engine has substantially stalled, and that's not good for retail sales, it's not good for corporate profits, and it's not good for the stock market.
And it's kind of interesting, Ed, because we know companies have a lot of cash on hand, but they're certainly not using that cash maybe to potentially employ more workers. So they're showing some nervousness.
I think we're in a classic chicken and egg situation where businesses are waiting to see customers come in the door. They want to see some actual demand before they start to hire people and expand. And at the same time, people are reluctant to spend because of uncertainties about the economy and their jobs. And even some people are uncertain about the impacts of the oil spill. I think that's having a negative impact as well.
You know, I thought it was great. I read in your notes, you say as a quant, I have to deal with the data as it is rather than how I had expected or hoped it would be, which I think is, I'd rather have an investment advisor who thinks like that rather than the kind that always want to backpedal and try and make the data different than it was. How have you repositioned yourself now to deal with the data that surprised you?
Well, we're basically much less aggressive in the portfolios. We don't have the big overweights of equities we had at the beginning of the year or for most of last year. So we're pulled back more or less in line with benchmarks. Still have an overweight of emerging markets compared to developed markets, but we're not as aggressively positioned as we were a few months ago.
And let me ask you, because for a while, you know, go back 6 months, 8 months, I think we were all talking about the other shoe to fall would be commercial real estate. We spent some time yesterday discussing it on our broadcast. What is maybe, though, the next shoe to drop in your view? Is it still some more news out of Europe?
Well, I think Europe has been a problem for a while. I had thought, though, that the United States recovery would somewhat offset that, and it doesn't look like that's happening. So we still have a worry that's going to be years in the resolution of what happens to European debt and how the countries there deal with their fiscal problems, which eventually, of course, may hit our shores as well. And so that backdrop, combined with still an economy that's growing, and I don't think we're going to go back into a double dip, but growing at a pretty weak pace, going to be tough to get a lot of traction in that environment.
Is it that what you see has changed, or is it that the visibility has actually decreased? I mean, is there more uncertainty now?
Well, I think if you look at just the hard data that we have, unemployment, on retail sales, and you're starting to get company reports suggesting that what was, what looked like a pretty good beginning to the year has stalled a little bit. Not necessarily falling back, but not seeing forward progress like we did in the first part of the year. Of course, earnings season is just about to start in earnest, and everybody will be looking very closely at those data to see what's ahead for the second half of this year.
Do you expect that to be weaker than as well? Do you expect earnings to come out weaker than you had thought they would, say, at the beginning of the year?
I wouldn't say that this quarter will be particularly weak, but I do think the things that have changed are with the strength of the dollar. That's going to have a negative impact for earnings, and I tend to focus at this stage of the year more on what's going to happen next year. And that I had thought that we might see as high as perhaps even $100 on the S&P next year. Now that looks quite unlikely, and we'll have to look very closely at what the companies are seeing on the ground to see how optimistic or pessimistic they are about the next year.
Ed, let me ask you, you mentioned the strength of the dollar. I know it's a little early, but we're going to talk to Jing Ulrich in a little bit about the China situation. Can you take any comfort in China's statement? I mean, as soon as it came out, the stories were out saying we're going to sell more airplanes and refrigerators over there, but now it's not so certain. Well,
listen, one of the big issues, it seems to me, in the whole financial crisis were the big global imbalances, where the United States was a big consumer, as there were other countries, and China, Germany, Japan, and others have more of an export-driven model. That creates imbalances which I think are not good for the long-term health of the global economy. So anything that moves a little bit more towards balance and an appreciation of the Chinese currency would be helpful there, I think, is a step forward. But I don't think we're going to see a lot happen very quickly. I think it's going to take some time.
Got it. All right. Hey, Ed, thanks so much for joining us. Ed Keon there with Quantitative Management Associates.